We're here to discuss week number 27 in Silicon Valley real estate market. We're going to start right off with the normal slide, which is the sale price to list price distribution. You can see that the purple line, which is the current week, is basically the same as it was last week, as the burnt orange. So basically what was happening is earlier this year, we were going up along this blue line. We hit the peak on March 26th of this year, and that's for closings. And this is regarding the amount of buyer pressure, how much they were willing to overbid. And then we turned around, and ever since March 26th, we've been basically coming down. Some weeks bigger jumps than other weeks. The dotted lines are the oldest weeks, followed by the dashed lines, and then the solid lines are the most recent weeks. So we're definitely cooling, but keep in mind, right here, something around 63% of the sellers in the Bay Area are still getting more than their asking price. So we can't be crying that the market's terrible, because when 2/3 of the sellers are getting more than their asking price, that's still a pretty fantastic marketplace. So it's cooling, but still strong. This is the same data, just as not as many lines. You can see now we only go back up 23rd. So this is already down a little bit from the peak. The dotted lines again are the oldest, and you can see they were grouped up here at the top. Then the dashed lines, the next oldest, and they were grouped down here sort of in the middle. And then we got down to the solid lines, which are the most recent week. The encouraging news is this week is the same as last week, but 1 week does not establish a trend. Here we're looking at two things. We're looking at available inventory. That's the blue line. So right now we have 20% more inventory than we normally do. And the big takeaway is last year over here on the right-hand side of the vertical purple line, we had less inventory. We had 80%. We got all the way down to 60% of the normal inventory. We started off this year at about 70%. And then right here, about week number 15, we started gaining inventory. We got a peak of 120. We had some perturbations here because of the holiday, and that was Memorial Day. And now we're back up to 120%. So you have a little bit more inventory. But the real story, in my opinion, is Silicon Valley is a demand-driven marketplace, and that's the red line. That's how many buyers want to buy, and this is measured by the number of offers that were accepted. And so last year, during the 2021, we were basically 20% above the normal level of activities, number of offers being accepted. And we started off this year at that 20% above the normal. The thing that has really changed, again, it's about week number 15, is we went from that 120% or 20% above the level expected demand by offers to 20% below. So overnight, you lost basically a third of the buying volume. And we've been basically around 80%. Yes, there's fluctuations, and maybe the real numbers were around 85%, but we're selling less homes now, less offers are being accepted than were earlier. And Silicon Valley tends to be a demand-driven marketplace. So when the demand has gone away, a third of it, the pressure goes away and prices start adjusting. The other thing that's really interesting to some degree, at least in my mind, is the gray line. That's the number of new listings that are coming on the marketplace. And yes, there's a lot of fluctuation because you're just looking at what's coming on the market in 1 week. But when you average that out, last year, you're basically just a little bit above the yellow line, which is 100% of where you'd expect it to be, but pretty close. The reason the spikes down happen is holidays weren't washed out. The yellow line is a 5-year median where holidays move from 1 week to another week. But basically, you were at 100%, maybe 105%. And what the big takeaway there, in my opinion, is sellers were not fleeing Silicon Valley. And there was a lot of media talk about that with remote working and things of that nature. But sellers have basically throughout this come on the marketplace at the normal expected level within a few percentage points. The real shift was those buyers. The buyers were 20% above, and now they're 20% below. That is what has shifted in the marketplace. Now what we're looking at is days of unsold inventory. That's the ratio between the two. The yellow line is the 5-year median. The 5 years that I use are 2015 through 2019. The red area is a seller's marketplace, and that's anything below 40 days of unsold inventory. 40 to 80 is a balanced marketplace. Above 80 is a buyer's marketplace. The thin blue straight line is where you're gaining 5 days of unsold inventory every week. And And that's basically the threshold of where, you're changing from one marketplace to another marketplace. And we're basically right at that threshold. You started above and you're now below. So you're a little bit less than 5 days. And it's also at a time when the inventory is normally climbing. You can see the yellow line, and that's raw count is normally climbing at this time of the year. So the fact that you're a little bit below 5 at a time of the year where it's normally climbing doesn't alarm me, but it says that this is something we should pay close attention to. And again, you're still in a fairly decent marketplace, somewhere around 65 days of unsold inventory. That suggests that you're in a balanced marketplace, and you still have some history because you were in the strong sellers marketplace for so long, but the trend is we're going up and we may hit the buyer's marketplace. And again, this is macro data. So this is Santa Clara County, single family homes, condos and townhouses, as well as San Mateo County, both types of property. This is sort of a table. It's a little ugly because it's new data that I've added in. This is looking at the number of offers that were accepted. And this is my Bay Area data, which adds in Alameda County and Contra Costa County. So now you have the 4 big counties that are about 75% of the real estate volume in the 9 Bay Area counties. So it was a reasonable benchmark. It's sort of the ones that are more influenced by the tech and what's happening in the heart of Silicon Valley. But the takeaway is, and I have 13 years of data, but I've only rated the last 10. And frankly, you can tell pretty quickly the 642 transactions that were accepted is the lowest, not only of the last 10, but of everything on here, which is 13 years. So it clearly is showing that the buyers on a broad scale have gone away. And we're not talking just about a little bit of numbers. You're 642, and the lowest number I'm picking up is 850. So you're 200, or, what is that, 20% below, 25% below. So that's consistent with what we're seeing in the smaller Bay, Silicon Valley area. We're going to skip over this data, and you can see that the purple line is the current line. It isn't updating, and I haven't been able to find out why. And I may have to redo the graph every week, which is a big pain. But for anyone that hasn't seen it, this is looking at the red line is the 5-year median. So that's what you'd expect the data to do. And these are the years where something significant happened, and something significant is happening this year because you're falling down pretty significantly. And then you have like 2020, which was COVID, which is the yellow line here. You can see the huge impact. It's a much more abrupt drop, but that was basically you can't show houses, but the duration is much shorter. Going on to the browner line, that's 2007. So that was the mortgage meltdown in February. And, it basically didn't rise. So it went level instead of going down. And, so it's hard to see the graph. And then in 2001, you had the dot-com bubble here, and you can see how shallow that slope is compared to the current slope, and 9/11, and we're almost the same as 9/11. So that's just raw count. Now what I did is I took the delta. So I subtracted it off of the 10-year median. So now I think you can compare apples to apples a little more easily because you sort of normalize the data. You're saying, what should the data be? And this is what it is. So you can see that basically on April the 9th, we had about 400 transactions more than you would have expected based on the 10-year median. And the 10 years in this case is 2010 through 2019. And now we're down here and we're 1,500 transactions short. And again, this data hasn't been updated since about the 26th of June. So I apologize for that, but that's life. So that's how you read this. And the real takeaway for me is you can see now COVID, the decrease was steeper, but the duration is shorter. But the impact of the current marketplace, which is no one specific event, is as strong as the dot-com bubble bust, and it's as strong and probably stronger than 9/11, which is the one that was supported me. And the 9/11 came down a little steeper, so that was a more dramatic impact, but the duration is half of what we've already seen. And that's just more of the same. So people, because we're in Silicon Valley, and I have a different view than most people believe that stock market really impacts the real estate marketplace. So I put out the 2008 stock market, and basically and I believe it was mid-August where the crash happened. and there's no impact on real estate at all as far as the number of transactions. Now what we're doing is again looking at old data, and I apologize, and I will probably try to get a post. I'll find out what's happened for next week, but you can see that the blue line now, the number of listings available is quite a bit above the number of offers, where the last several years they were right on top of one another. And when you have more inventory in the Bay Area than you have offers being accepted, that puts downward pressure. So even though we have not been updated since, in this case, July 2nd, so we're missing this week's data, there's not going to be any drastic changes. The same with this slide, and we aren't updating since July the 2nd, but your DUIs continue to go up, and you can see it went from here somewhere around 53, and if I remember correctly, the number was somewhere around 64, so this vertical trend has continued. You can see the little pauses here, which is sort of interesting. I don't know what caused the pauses. Normally when we're shifting, you get a nice straight line like this. So this year we've gone up, pause, gone up, pause, gone up. So I don't know what the difference is. Again, broken record, we're not updating, but the same concept's happening here. This is days on market, and this shows you why I don't use this number normally. The media does it, and I include it for inclusives. The median days on market have only gone from 7 to something like 9. So if that's the number that you're benching the mark on what the market's doing, you would say the market really hasn't changed. Where if you're using the DUI, which I think is a much better benchmark, and that number's gone from something like 17 to 52 and now up to 64, that gives you a much better indication of what the market's actually done. They're all data, they're all accurate. It's just a matter of which one you believe in and which one you think gives you a better indication of what the market's doing. This is now the median price, and the yellow orange line here in the middle is the median price for the macro data, which is a product that doesn't exist. This is the lowest 10 percentile, and this is the most expensive. So it's difficult to buy real estate for below about $800,000 or above 3.5 million. Now, obviously you can, because there's still 10% of the market above 3.5 million. And when you eliminate condos, the percentage of the single family homes above 3.5 million is even higher than 10%. The same with condos. When you eliminate single family homes and you look at condos, you can get down into the $400,000 range, $500,000 range. This data is a table, and therefore it's updated. For some reason, it's the graphs that weren't updating. And what we're doing now is we're trying to look at the greater thing. Normally, I had been following just San Mateo County and Santa Clara County. Now I've added in Alameda County and Contra Costa County. So you're looking at the number of new listings, and the number of new listings this week is up across the board. And the reason for that is simply last week, people were going into the July the 4th holiday, so sellers don't put their house on the marketplace. Now, even though it's the holiday week finishing up, we're going into essentially the new week of real estate, and sellers are willing to come on the marketplace. So you had a big decrease in the number of new listings last week. It's not really a huge increase this week. So when you have a holiday impact, 1 week isn't very significant and is basically hard to tell anything. So now you jump down to these numbers, and this is the same data, but looking at 5 weeks. And you can see, in some areas, the inventory is down, like in Santa Clara County, it's down 1%, but in Alameda County, it's up 10%. So you can see that the counties don't go all in lock, stock, and barrel. And here's a bigger difference. In Contra Costa County, condos and townhouses are up 19%, where in San Mateo County, they're down 17%. Not huge, but significant. Number of offers accepted. Now, this week, the number of offers accepted is going to be way down. That isn't necessarily a market shift. That's the holiday impact. Because last weekend was a holiday, you had less new listings for buyers to buy, and buyers were busy doing other things. So your offers accepted as a result of last weekend's activity was way down, and I expect these numbers to be up. Now you get down to DUI, comparing this week to last week. I would probably go back and look at last week's data versus this week's. And again, it's because the number of transactions are way down. But what I would really do is jump down and look at 5-week data. It's more stable. It gets over the holidays. And you can see here in Santa Clara County, single family homes, we went from 52 to 55 days. In Alameda County, 49 to 56. So when you see a broad increase, and down here's the number of days of increase. San Mateo County was the only one that did the decrease. You can see that the market's slowing. And then on closings, this is 5-week data down here only. And there's some interesting data. Let's see if I can pick it up. The appreciation now is down around 30% for the most part. And again, my appreciation is different than most people's appreciation. I'm using this off the base sheet calendar year of 2020. So it's a base of a whole calendar year. And that's so I have a rock solid base. And for those that have been following me for any length of time, know these numbers were up in the mid 40s. So we peaked not that long ago, somewhere with mid 40% appreciation, and now we're down to 33% appreciation. So it depends on how you want to look at this. 33% appreciation since 2020 is pretty fantastic. That's like 17% appreciation per year, maybe closer to 15 with compounding. But if you turn around and look at, we were at 43% and now we're down at 33%, and you've lost 10% in just a matter of a few weeks. That's not so dramatic, but that was the frantic overbidding. With that, that's the brief recap. I'll pause here for a second and see if anyone's got any questions for me before I go into a little bit more detail.
Hey, Richard, so you think that the market's going to keep going down? When do you think we'll hit bottom? What are your thoughts?
My crystal ball's been broken for years. My biggest lack of understanding is the things that have impacted the real estate market, in my opinion, are things like the war, worried about inflation at the grocery store, worried about interest rates on the mortgage. Those have all been happening for a long period of time. And something happened in the consumers that were buying right around May 2nd, I think is the week. And the reason it's May 2nd instead of April, when you look at all the downturns, the downturn bleeds back about 4 weeks, because whatever spooks the buyers, the ones that are in escrow also back out. So it goes back retroactive. So the retroactive blend down was back to April the 9th, where the real event was May the 2nd. And I cannot identify anything that happened on May 2nd that would have overnight caused the buyers to go from red hot marketplace to ice cold marketplace. And if someone could possibly identify what that was, that would be great. But there was some event of the magnitude of the dot-com bubble burst, of the magnitude of shelter in place, of the magnitude of 9/11 happening that spooked the buyers. And until
Was it the interest rates going up?
No, they started going up in January.
Right, but not 0.75 basis points. That was huge.
But I think what you're referring to is the feds. And
yes.
The feds don't really directly impact real estate and never have. The investors in real estate see that coming ahead of time and start raising the rates. So interest rates were at 3% in January. They were probably 4% in February, which is a bulk of your increase. And I did that calculation on the impact that has on purchasing power. So the impact on real estate was not May 2nd.
But interest rates are at close to 6 now. So I know I had a deal in contract and the buyers wanted to back out because they couldn't get the interest rate at the.
You got to be a little careful. They're not really close to 6. And we have a weird thing going on. Conforming interest rates now are significantly higher than jumbo rates. And this is from my memory, which is not perfect. But Wells Fargo is somewhere, and I could pull it up the rate sheet, but is somewhere around 5.5% for conforming loans, but it's somewhere around 4.5% for jumbo loans. So I'm putting clients into jumbo loans that are borrowing $650,000 because they're getting a lower interest rate. And it's crazy. Low-end properties are getting impacted more because of the interest rates, because they're stuck paying that 5.5% interest. Again, you can have a that's not even a doubling of interest rate. And when you did an increase of a third of the percentage of the interest rate, that only negatively impacted purchasing power by 17%. And this is a wild guess. If you go up by a doubling, the impact is probably somewhere around 40%. And that's because as the interest rates go up, the amount of principal goes down, the property tax and insurance stays the same. And so the debt ratio is what qualifies people. I don't think it's the interest rates. Interest rates have always been overrated, just like the impact of the stock market has been overrated. But I will, and maybe what we should do is pause for a second if people, we could pull up and see what kind of feds raised the rate. Do a quick Google search and see if I can find up that when feds raised rate. because if that was May 5th, then it would be close. I'm not seeing anything pop up real quick. Does anybody on the line know when it happened? And I probably shouldn't take up our time doing this, but when did feds raise rates? When interest rates go up, have the feds on June 15th. So the feds on June 15th raised it to 0.75%, so that was 45 days after the buyers already reacted. So I would tend to say that that's not the event. I don't know what the event is, and I'm open to.
They throw out a lot of fear before that happens, and a lot. So, and people start saying, well, it'll definitely be 0.5, or half. And then it jumps to 7.5. I don't know. I think it's a lot to do with the perception of interest rate too, because there was kind of a rush, usually when they're going to raise interest rates, but now they're doing it so rapidly that people, I think, are just kind of scared.
Well,
I don't know, but that's
buyers are definitely hesitant for whatever reason. The reason I don't think it's interest rates is sort of like you're saying. The Feds increased it. I even forgot what the date was, June 5th or June 15th. That's the date set in stone. But if it's a gradual bleeding of perceptions, which is what they want to do because they want to avoid this, one, the impact isn't going to be like a 9/11 event going with a plane crashing into a building, which is what we're seeing. It's not going to be like a COVID event. There was a black and white line on basic May the 2nd that freaked out the buyers. And it's the fact that the feds went out and people were expecting rates to go up. So people would have gradually pulled out of the market. They wouldn't have abruptly pulled out of the marketplace.
So was it the stock market that would affect Silicon Valley? I don't remember when it took a dive. I think it was started down in January, but then I think there was some point where it took a bigger dive and then semi-recovered. So I don't know yet what that is, what date it was anyway.
Yeah, and my first thing is the slide I just showed you, where 2008 we had the big stock market crash, and that had no impact on volume of transactions in Silicon Valley. The impact of stock market this year was less than August of 2008. So why would the impact on real estate be far greater? It just doesn't add up when you analyze it. People like to hook things on things that happen, but when you can go back and find things that refute it, you have to move on. So, and I think we do need to move on. So let's just recap. Something happened on around May the 2nd of this year that I have no idea what it is that really impacted the real estate industry. And until I feel comfortable in knowing what that is, there's no way to predict how long it will go. The downcrease.
Richard, let me throw in one thing real quick.
Sure.
The Netflix stock was right around then. That was the end of April when Netflix was really going through some turmoil. So maybe the market interpolated that into the overall Silicon Valley market.
Interesting. So one stock drove the whole marketplace?
Well, I mean, the Netflix was a pretty big deal with layoffs and a big stock correction. So I don't know if it was driving it. There was a few things that were happening relative to Silicon Valley stocks that could have had an impact. I don't know.
Wasn't it only 300 people got laid off?
Yeah, but the word layoff I've heard it from a few buyers.
Well, I've lost one buyer because his employer said that if the economy continues on the current trajectory, there will be some company layoffs, and that pulled my buyer out of the marketplace. And that's one of the things that I think is huge that people don't have in any of their prediction models. They use things like the rate of unemployment, they use the interest rates, they use a lot of benchmarks, but one of the benchmarks that I think is probably far more important than the rate of unemployment is the rate of change of unemployment. And that's what John was talking about there a little bit, is we went for a strong economy where the unemployments were basically real low and stable to all of a sudden companies starting to threaten layoffs, and you don't know who's going to get laid off. So for every one person that's going to get laid off, maybe 10 people pull out of the marketplace. And my client's a great example. The company went company-wide and said, we don't know how big or when or if it will happen, but we want company-wide employees to know that we may be looking at layoffs. Current economy continues. That freaks out the whole employee base versus just those that will actually lose their job. So the rate of change of unemployment is far more important, in my opinion. I look at what the market's actually doing to spot changes in the marketplace.
Maybe it's just the fear then that happened. A lot of companies, maybe they did announce it to their employees and they all panicked. I don't know. Interesting.
It's the best theory I've heard so far. I'll do some homework on it. So moving forward, the yellow line is where you'd expect inventory to be based on the 5-year median of level of inventory. So you can see the shortage of inventory at the beginning part of 2022. You can see we spent a couple weeks right with the normal level of inventory, and now we've crossed over and we have above the level of inventory you'd expect. Not hugely in raw counts, because you'd expect about 2,000, and we're somewhere around 2,375. So 300 more homes on the market, 15%. I guess the number might have been closer to 20% more homes on the market than we'd expect. So not a huge number, but still some. Here we're looking at the number.
Is this all areas?
No, this is just Santa Clara County, San Mateo County, single family homes, condos, and townhouses. I am trying to label every graph, every table now that I have so many different data points. But here, what you can do is the yellow line again is the 5-year median number of new listings. And here you can really see the number of new listings coming on the marketplace has been exactly where you'd expect it to be. We've not been flooded with sellers. We've not had sellers fleeing Silicon Valley, because if sellers were fleeing Silicon Valley, there would be new listings on the marketplace. Whatever's happening has not impacted the volume of sellers. It's impacting the volume of buyers. This is the buyers. So now the blue line is above back here at the beginning part of the year. So you had more offers accepted than you were expecting. And now you flipped over and you had less offers expected, and it's the flip over and the decrease. And here you can see that you go back to about week 16, and this is because it's bleed back, because these have to be successful offers, etc. So you get some bleed back. Here, unfortunately, the data does not appear to me to be being updated. This is my days months sold inventory, so you can see the growth, and that's not good. Normally up and to the right is good. And I think the last data point here is last week, July the 2nd. So I'd expect it to be up a little bit. In fact, I think the number was up here around 64. The blue line is my 5 days per week, and you can see that the gap here narrowed. So this line, the current data line, is not as steep as the warning lines. Here is the heat map. So now you're starting to see, and this is current data, this shows you the distribution. We've gone from bright red almost all year long to almost a lot of pale blue. So there is some red still on the marketplace. Redwood City, for whatever reasons, is still red hot, and it's a new yuppie place to buy, I guess, as well as Cupertino and Sunnyvale. Everything else is basically in a balanced marketplace or starting to get into a buyer's marketplace here in Saratoga, Los Gatos, or up in the San Mateo County, and even up here in the affordable areas, Milpitas, North Valley, Santa Teresa, Blossom Valley. Here shows you that over time. So this is looking at DUI. You can pick whatever micro market area you're interested in. So you can go back here on May 7th, and basically we were on fire. May 14th, you got a little bit of white coming in, and it got paler and paler. And then you can start seeing the blue come in, and you can see fluctuation. You went from blue to dark blue to pale blue. So, there's fluctuation from week to week that you expect, but you can start seeing the trend. And all this down here is white, which means no color balanced marketplace. So you can see that and some people might even say, up through May 28th, Richard, you were pretty strong. But remember, every data point has its pluses and minuses. And I would say that this graph here, or this column here of color, is paler than back here on May 7th. Here's the frequency of overbidding. If you want good news, here's a little bit of good news. And I believe this is accurate. It's an increase a little bit. We were down at 60% of sellers were getting more than their asking price. We bounced back up to 65%. So a slight increase, but not where we were for most of 2021, and clearly not where we were earlier this year. Here's the frequency of overbidding of the counties. And again, I apologize, it's not updated, so we'll skip right over. This is current data. This is the frequency of overbidding. Frequency of overbidding is going to lag redder. It's going to lag behind magnitude. Buyers right now are still willing to overbid a seller's asking price, and that impacts frequency. What they did is they pulled back from paying 120% or 20% above the seller's asking price to only paying 3% above the seller's asking price. So that still counts as an overbid, but you'll see this lags behind the frequency. So again, this is pretty red in color. but it's lagging because of what I just talked about. It's also lagging because you need sale price, and it takes about 5 weeks to get your sales price. This is the magnitude. This is what I said would drop more rapidly. So macro data, so just the two counties, two types of property, you can see we were about 116%. Now we're down around 103.8%. So pretty dramatic drop. Put it in perspective. Last year, we were only at 8% overbidding magnitude most of the year, and most people thought that 2021 was a fantastic year. So we're nowhere near where we were earlier this year, but we're still in a strong marketplace, which is why this is shaded red. So we need to keep some balance here going. This is the magnitude overbidding. You can see that the magnitude of overbidding has dropped down pretty dramatically. This gives you the individual counties. So red is Santa Clara County single family homes. You can see you were probably somewhere around 117.5%, and now you're down to something like 106%. So a pretty significant drop in a fairly short period of time. Here's the magnitude. You can see the magnitude is much paler pink than frequency, which is what I said would happen. And again, this is going to be lagging by 5 weeks as you need the sale price. Here is the sale price. And again, because of the graph, it's not updated. So here's the updated numbers graphically for you. Now, this has nothing to do with red hot marketplace, ice cold marketplace. This is simply price. Median price is in Redwood City. It's white in color. If you're above the median price, you're pale pink like Cupertino down here. If you're below, you're going to be pale blue like Santa Clara. The bluer you are, the more below sale price you are. The redder you are, the more above. The colors assigned by the median, which is the middle number. The number to the left is the 10 percentile number. The number to the right is the 90 percentile number. Here's the appreciation. This is my bizarre number, which I like actually, and I probably keep it for a while longer now. But my base year is the entire calendar year 2020. So you can see the yellow lines were basically your peak, 57%. Now you're down to 32%. So depending on how you want to look at this, you're up 32% from the median sale price in 2020, which is how I prefer to look at it. If you want to be pessimistic, you can say you were at 57% and now you're down to 32%. So you've lost 15%. So you can pick whatever micro market area you are. What's noteworthy in condos, some areas are now less expensive. The homes are selling for less money than they were in 2020. So the 2 years of appreciation that they had, which were not as great as single family homes, but you still had 40%. Well, the 40% is still 14% above, but 14% is now negative. So that starts to become, you now have a lot of people that have bought condos that have that negative equity by 1 to 14%. This is looking at a summary. This is current data. So you can pick what micro market your area you're in. You can get a quick look at DUI, the frequency, the magnitude. And here you can see the frequency is darker than the magnitude. And then you can see the price, or you pick your price and see what kind of market conditions. So the DUI is sort of the leading indicator because you don't need sale price, and that's where you're going. So the trend is, I expect these numbers here, the magnitude and frequency of overbidding, to go down because I'm starting to have blue in the DUI and that lag time hasn't come through. Here's a little breakdown for you. So the different components, you start with the active, then you have Santa Clara County, San Mateo County, single family homes. So you can see you have more inventory, and the amount more inventory that you have depends on where you are. And it varies quite a bit. Only 18% more in Santa Clara County. Santa Clara condos, 81% more. We've crossed out Bay cities because I've talked about that in other meetings. Here we have the DUI. And again, this is the leading indicator. 40 to 80 is a balanced marketplace. So it's still a balanced marketplace. And then your frequency, and here's your overbidding. So here's your peak overbidding in 2021, your peak overbidding in 2022, and not overbidding, but peak appreciation over the entire 2020 calendar year and what the current numbers are. So now in San Mateo County, this is blue because you're below the peak in 2021. So we've wiped out the entire appreciation of 2022 for San Mateo County. Same for Santa Clara County condos. In fact, the only area that's up from 2020 or 2021 is Santa Clara County single family homes. This is accurate data. This, I believe, actually, I didn't even have time to check it. This is accurate data.